Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hey, everybody. Welcome to the DIY Wealth Canada podcast. I'm Bob with my co-host here, Nelson. Today, we have a very exciting episode and quite interesting. We're going to talk about dividends versus indexing. Nelson, why are we talking about dividends versus indexing?
Well, the answer is, of course, is that everybody wants to have this argument and everybody wants to win that their style of investing is somehow better than the other guy's style. So because of that, this argument or this discussion is very prevalent in the world of investing on Twitter or Reddit or wherever you go. It seems like everyone kind of wants to talk about it. So we figured, why not? Let's throw our hat in the ring.
Yeah, and I think we'll just have a discussion. We'll probably take the side. One of us will take one side and the other take the other side. So what do you think, Nelson?
That's it. Let's do it. And let's not, swear at each other. No, we'll have a good time with it.
Yeah. So why don't you take the dividend side? I'll take the index side. Go from there.
Sure.
All right. So right off the bat, I think index is there are a lot of advantages to indexing, right? So it's easy. You get better diversification. It's simple, right? You're simply just tracking the market performance. And, with index ETFs nowadays, it's a lot lower fees than mutual funds. So that's the easy way to invest the market, right? Just index and then buy regularly. That's the simple approach and a lot of advantages with indexing. Over to you, dividend advantages.
Well, I think the biggest advantage to dividends is that you better control the amount of income that your investments generate. To generate income off of most indexes, you are either forced to live off a very small dividend stream or you're forced to sell shares at a regular basis. And that decision for the average investor is quite difficult. I don't believe the average investor is very good at selling in general, and they're especially not good at sort of a selling decision of I have to sell something. When's the right time to sell? You'll often see that people will liquidate at the worst possible time because that's when the market is the lowest, where fear is the highest. And so that's a mistake that is often made by total return or index investors. Secondly, is that you get a lot of exposure to certain parts of the market that perhaps it's not the right time to get that exposure. So if we look at, say, the S&P 500, which of course is the world's most famous index, you see a lot of tech exposure on the top of that index. And therefore, the bet on the S&P 500, even though it's quite diversified, is really a bet on technology. And technology, of course, has done very well over the last 10 years. And that's one of the reasons why the S&P 500 index has done very well. But that could change. And if it does, then there's a risk of that index underperforming, just like it did kind of in that 2000 to about 2012 time period. I believe it was flat or even down during that time period. So those are a couple things that as a dividend investor, I look at and I say, maybe this isn't the best asset for me to own. I would rather own individual stocks that pay dividends because ultimately my goal is to retire on dividend income. And to do so, I want to invest in dividend-paying stocks.
Yeah, valid points. I think the key to index ETF investing is that you pick one index. Like for example, you said S&P 500, or even nowadays there are all-in-one ETFs, right? So the XEQT, VEQT are two famous ones where you buy 100% of the market. It's globally diversified. So it's a very simple way to get into investing in the equity market, right? So that's probably the biggest advantage is just you buy one, you're right away diversify sector and geographically, right? And simple, right? Obviously, you need to think a little bit about selling later on, but when you're in the accumulating phase, it's very, very easy. You just buy one and invest your money regularly and forget about it. And put the emotional side aside and just regularly buy. And dividend investing definitely has its advantages as well, like you mentioned. So, I mean, I think it just kind of depends what you gravitate towards. Right now, let's talk a little bit about the disadvantages of index and dividends. So I'll let you go first, Nelson. What are some disadvantages of dividend investing?
Well, one is that you typically end up with a portfolio that may not have exposure or a lot of exposure to certain sectors. I talked about tech and how tech has been working, and a lot of dividend portfolios don't have a lot of exposure to technology. You look at the big tech companies, you have Apple, you have Microsoft, you have Nvidia. And while all those companies do pay dividends, and Apple and Microsoft are two very popular dividend growth stocks, both of them offer very small dividend yields. So if you're looking for higher dividends, you're going to avoid those sectors. And in doing so, you're going to create a portfolio that is not perhaps as diverse as before. The other disadvantage is that when you're too dependent on dividend sort of esque stocks and interest rates go up, is that your portfolio ends up being more of a interest rate rated or interest rate linked portfolio, and therefore will underperform in periods where interest rates are going up. So in essence, you could argue that a dividend portfolio is a giant bet on interest rates, and there are maybe more effective ways to make that bet rather than just investing in dividends. So ultimately, the big downfall comes down to a lack of diversification. And, there are various ways that you can sort of correct that, but then you're not really dividend investing at that point. You're, factor investing or whatever you want to call it. Is there anything you can think of to kind of add to my points of the disadvantages?
In terms of dividends?
Mm-hmm.
Yeah, I think one would be it requires more time to evaluate the different stocks and requires a little bit of research, right? And then purchase. It's not as simple as index where you're just buying one fund. So for you and me who are interested in research companies and we are, we get a kick out of it, that we don't see that as work, but for some people, they may see that as something that would put them off to dividend investing.
Yeah, for sure. And I think too that if there's one thing to have the interest in it, and then there's another thing to not be very good at it. So I have started playing online poker a little bit, and what I've discovered is that I'm quite bad at it, and I can't even make money playing against people for play money. So if I can't do that, then I'm not going to graduate to real money because I obviously suck at online poker. Hopefully I get better. But, like to sort of extend that metaphor is that if you're picking individual stocks and you're bad at it and you're not picking the right ones, you're not even getting close to beating the market, then obviously that is a situation where I 100% agree. It's like you should not be picking stocks at all. So there's that factor to consider. I'll throw in a kind of a rebuttal to your argument though, which is that if someone does want dividends and they don't want to choose individual dividend stocks, there are dividend ETFs that exist that let you get a nice diverse portfolio of dividend stocks for a very low cost that should kind of generate income and slowly grow over time. Now, obviously, an ETF will pick a large selection of dividend stocks, so there may be some dividend cuts in there, but for the most part, it should work. And you look at Canada's largest dividend ETFs, VDY, which is the Vanguard Canadian Dividend ETF, and it has done well. I believe it's returned about 12% annually, including dividends, for the last, call it, decade. Those numbers might not be right, but the point is that it has performed pretty well. So if you don't want to choose individual dividend stocks, but you do want to invest in dividends, you can go that route as well, which is sort of kind of a hybrid of the two, where it's like you're dividend investing, but you're also taking all the guesswork out of it and just buying the ETF. Bob, let me ask you, in terms of index investing, one of the downfalls I've sort of thought of when it comes to that is that there are so many ETFs out there and there are so many indexes that could be followed. How do you pick the right one? And how does a DIY investor who's listening to this, who might be new at investing, how do they pick the right one?
Yeah, it's definitely getting more and more confusing nowadays. There's so many index ETFs, and even there are passive ETFs and there are active ETFs and sector ETFs and everything in between. It's quite difficult if you don't know what you're doing, and you're kind of throwing a dart randomly and just picking one, right? Now, I mentioned XEQT and VQT. Those are the Vanguard and iShares or equity ETFs. Those are pretty good. We invest our kids' RESPs in XEQT, and that's all we do with their RESPs. And you can also pick just a market index, right? So Nelson, you mentioned VDY, which is the Canadian one, and then their S&P 500 index. There's also NASDAQ 100 index. So QQQ is a pretty popular one. I think one of the disadvantages of indexing is really, like you said, which one do you pick? And I've seen a lot of people that end up having with multiple index ETFs, and they're overlapping each other quite a bit. Like somebody may get XEQT, and then they decide to buy VDY, and then they decide to buy S&P 500, and then maybe they dab a little bit on QQQ as well. And you're going to end up with a bit of overlap, and that's potentially a disadvantage, right? Because you're already very diversified, but by having overlaps, it's not ideal. Now, the other thing is when you pick an index, you're really, and that's true for dividend ETF as well, is that you're losing control over the selection method. Right? Sure, if you're investing in S&P 500, it's just the S&P 500 index. But if you're investing in XEQT, you have no say of what the exposure are in terms of the different countries, right? So they may pick, 20% Canada, 40% US, and then rest is other countries. And then within the 40% US, you have really no say what the makeup of that 40% is. They may decide to go with the S&P 500 route or some other methods, right? So that's becomes a little bit tricky. And then the other thing, the really big disadvantage in terms of indexing is that you're paying the management fee each year regardless what you're doing, right? So you're paying like 0.5 or 0.025% MER typically with these index ETFs, which are pretty low, right? But you're still paying some money, right? So you can imagine if your portfolio's, I don't know, $1 million, 0.25% is still not a small amount of money, right? Now, if you have $1 million portfolio, 0.25% each year is not a big money, but it's still some money, right? So you're paying that regardless what you're doing. And that drives to the other point is lately there's been investors that just try to chase the lowest MER possible, right? So they may hold index ETF A, which has an MER of 0.5%, and then all of a sudden another ETF, which is the same makeup, like in ETF B now has an MER of 0.5. So then liquidate index B and then go into index B. And then they're always constantly chasing that lowest NER ETF. And I think that's not healthy because you're just switching. And when you switch, you may lose some return. Right? So that's perhaps one of the disadvantages as well.
Yeah, especially if you're taking that action inside a taxable account. If you have an S&P 500 ETF and you sell that to cycle into another S&P 500 ETF, you've created a taxable event there. You have to pay the tax on those earnings. Obviously, if you're holding such an investment in an RSP or a TFSA, those tax implications aren't there, but they definitely exist on the taxable account or the margin account side. I think too that you really talked about this point of not overcomplicating it, and yet so many people do, and so many people kind of have this desire to make it just, they try to make it so good that in reality they're really working against themselves. You talked about this overlap of you might have an S&P 500 ETF and then you're pairing that with a NASDAQ 100 ETF. Well, a lot of the companies in the NASDAQ 100 are already in the S&P 500. You're just it's work for no benefit. And I found that when I see a lot of ETF portfolios, whether people post them on Reddit or on Twitter or whatever, you see a lot of that kind of over optimization that really works against them. And so I don't know, like, is that a disadvantage of indexes or index investing, or is that just investor behavior? I don't know, but I see it a lot and it's quite discouraging from my perspective. You got to just set these things and forget them.
For sure. I think the general thumb rule is keep it simple and keep it stupid. And really, the way I like to explain is if you can't explain to a 5-year-old, you need to rethink about your strategy. And that's definitely something I try to, whenever my kids, they're a little bit older than 5 years old now, but whenever they ask about investing, I try to simplify and make sure I could explain to them. Because if you can't explain your investing strategy to a kid, there's a problem there. You shouldn't be able to explain it regardless what you're doing.
Yeah, one concept I've used over the years is I look at the dumbest rich guy I know, and I don't want to say any names or anything, but you look at these guys and it's like, what is a guy who I look at him and I don't think he's very smart, and yet he ended up wealthy? Like, what did that guy do? And it never fails. It's just they either bought, something like residential real estate and rented it out and just did that over and over again. They invested in a simple index fund, S&P 500, TSX, whatever, or they bought blue chip dividend, maybe not dividend stocks, just blue chip stocks, and they dollar cost average into a portfolio like that for 20, 30, 40 years. And those are the strategies that work. And then there's the ultra complicated stuff that I feel like the failure rate is higher than normal, and it's just overcomplicating it for the sake of overcomplicating it. So it doesn't matter whether you're investing in dividends. Dividend investors are guilty of the exact same thing. It's just find a strategy, keep it simple, and like Bob said, be able to explain it to your children or someone who doesn't know finance at all. And if their eyes glaze over, then you're probably too complicated. Yeah, that's
exactly.
just, I love simplicity.
And I think it's the whole index versus dividend, maybe going a little bit off the tangent here, is that it's so one-sided. It's so heated, right? It's like if you're a dividend investor and then you're talking to an index investor, and all of a sudden it's like, oh, you're not indexing, therefore you're stupid. You're like, what are you doing with your money? Or vice versa, you're dividend, you talk to an index, it's like, oh, why do you throw your money and invest in in the S&P 500. That's dumb. Like, why do you want to touch your
Yeah.
principal? It's almost like everything or nothing, and I don't think that's healthy. And again, it comes down to your personal preference. Personal finance is very personal, right? What works for you, Nelson, may not work for me and my wife, and vice versa, right? And that's where you need to pick a strategy of your own. And I recently heard about this analogy. I really like it. Is that asking like index versus dividend is almost similar to asking what's your favorite type of food. You can't tell me Japanese food is the best food in the world, right? Everybody's taste bud is different. And just because I like Japanese today doesn't mean I want to eat that every single day for the rest of my life. I might want to do pasta, Italian food, for a few days here and there, right? So there's no one answer that just is the right answer, which is I think where the debate gets complicated, because everybody's out, this is the only way to do things, or no way. And I think that's wrong.
Exactly. It's all about getting to the finish line so you have enough money to take care of your retirement or whatever your goals are. Your goals might be generational wealth. Well, then by all means, go for it. It's just you're going to have to do things a little bit differently if you want that versus, maybe retiring on your own in a more modest way. And ultimately, I think the 4% rule that people often talk about in terms of retirement planning, I think that the 4% rule, if we really sort of look at it from 10,000 feet and really strip it down to what it is that you're taking the earnings of large established companies and you're living off those earnings in retirement. Whether those dollar amounts come from selling shares or whether they come from dividends, they're both doing the same thing. It's just the execution is slightly different. So at the end of the day, it's like kind of 95% similar in that they're both using earnings from these companies to fund retirement or fund whatever. It's just sometimes some people are selling, other times some people are collecting dividends. But at the end of the day, it's still the same thing when it comes to that.
Yeah, for sure. I mean, it's kind of, you're indexing, you're selling, I think some people call it creating your own dividends, which in some ways is true, right? And then if you're just relying on dividends from the stocks that you own, you're basically companies are paying you their profit, right? So very similar. Now there's the whole side of tax efficiency that comes into play, and I think that gets quite complicated because people are saying, "Oh, why do you want to invest in dividends?" Because when you sell and you have a capital gain, it's 50% of your marginal tax rate. Yes, that's true, but dividend stocks, the one that get eligible dividend or qualify for eligible dividends, they're also very tax efficient, right? So, and then we're only comparing in non-registered account. Now, if you put it into consider TFSA and RSP, that complicates the equation further. So it's not just this. Again, is not this is the way to do things for everybody. There are multiple millions of different paths to get to the end. And Nelson, you talk about your end goal is like, yeah, that should be the thing everybody should be focusing on. It's not about beating the market. Yeah, it's nice to beat the market, but if your end goal is to have, I don't know, $100,000 from your portfolio each year, such you could retire, does it really matter if you're beating the market or not beating the market? Right? Like we should be focusing on that angle. Now, some people may argue that's not the way to see things. That's totally fine. That's how I feel. What about you?
I think the difference in the like the goal you're talking about being the market, I think that if you manage money professionally, that is absolutely a goal that clients have for you, or else why bother? Why bother giving someone that money to manage if they're not going to beat the index, when you can match the index on your own without having to pay that fee. So that's a very legitimate argument when you're paying someone to manage your money. But when you're managing your own money, other factors come into play. Do you enjoy it? Are you doing well enough that, so if you say make a 9% return and then a equivalent investment managed by someone makes an 8% return, say 9% minus say a 1% fee. So then your benchmark at that point, I could argue, it's not the index, it's that comparable product that you would buy from a financial advisor or whatever. And of course, the financial advisor is going to say, well, I offer more than just portfolio management for that 1%. And we won't go down that path. But the point is that when you're managing your own money, I don't think that beating the index is necessarily the number one goal that you should have. Again, you should work backwards from what you want your retirement to look like and say, can I accomplish this managing my own money? Do I enjoy it? Do I get to meet people who like to invest and it's an interest of mine? Those are all very legitimate questions that should be asked. And if the answer to them is you manage your own money and you underperform the index for 40 years, as long as you end up with enough to make all of your retirement dreams come true, I don't think that's a major loss for the individual investor.
Yeah, definitely agree with you there, Nelson. We're kind of moving away from this index versus dividend debate here. Anything else you wanted to add on index versus dividend?
Yeah, I'll talk about, there's a lot of information out there. People have done studies about how dividend stocks generally outperform non-dividend stocks. And, if you're into dividend investing, you've obviously seen these studies. If you're not, I'll kind of summarize them a little bit here. So basically the thought process is that, dividend stocks do outperform. We've seen this on the TSX. We've seen this on the American exchanges. Now, what's the reason for the outperformance? And we could debate that all day long, but essentially I think it comes down to that dividends are sort of a selection mechanism for good companies. It means that if a company pays a dividend and a company pays a growing dividend, what we see is that growing dividends tend to outperform the most. Is that the company doesn't outperform because it pays a dividend. The company outperforms because it has the characteristics that allow it to pay a growing dividend, growing profits, sustainable profits, predictable profits, generally, things like higher profit margins. They generally do better during recessions because of just the nature of the business. They're generally more predictable. And generally, too, dividends paying stocks tend to trade at a little cheaper valuation than non-dividend paying stocks. So the thought is that you combine all of these factors and dividends have then outperformed. And this phenomenon has existed for 50 or 60 years, as far back as they've gone to measure it, except for the last 10 years. The last 10 years, non-dividend paying stocks have started to outperform dividend stocks. So my question to you, Bob, is that should we look at this gigantic piece of history that's out there that says that these types of investments should outperform again in the future, or have we kind of entered a new reality of indexing, sort of lower dividend stocks or no dividend stocks outperforming? What are your thoughts on that?
Yeah, it's a very tough question to answer. I think historical return definitely gives you some idea, but with AI and all these different tech companies, it's hard to say what the future looks like. But if you look at the tech companies, the Apple, the Microsoft, the Google, or Alphabet, the Meta, they all have started paying dividends. Interesting enough, although it's not very much. But in the case of Meta, for example, when they started paying dividends, the stock jumped because everybody was like, "Oh, now it's great that it's paying dividends." Now you have outliers like Tesla obviously doesn't pay dividends, Amazon doesn't, and a few others, right? But do you now consider the Nvidia, the Meta, the Apple, the Alphabet of the world dividend stocks, or do you still think them as tech, like high growth stock? You could argue both ways, right? Because these companies don't pay that much; they're paying fraction of a percent in terms of yield. So for the most part, they're still growth stocks, but they do pay dividends. So I don't know. I think there's definitely some attractiveness in terms of paying dividends, or even for these tech companies. It's kind of like they have entered a new phase of the and where they no longer need to reinvest that money into the company. They could afford to pay some dividends, some money, some profit to shareholders to entice them to continue to hold these stocks. So yeah, it will be interesting moving forward to see how things go.
Yeah, I wonder if we'll see, like you mentioned, these dividends are not very big. I'm thinking of Alphabet's or Google's dividend, and not only is it very, very small, I think it's about a 0.1 or 0.2% yield, but they only increased it by 5% this year, considering that Google's earnings typically grow faster than that. So, from a dividend investor perspective, I see a company like Google, like Amazon, Meta, like all these companies that either pay very small dividends or don't pay any dividends. And these companies gush cash. They make a lot of money. And rather than pay dividends, they seem to be more focused on share buybacks. And part of that reason, of course, is Bob, you're in the tech world. You know that people get compensated with stock bonuses. And that's a way for these companies to sort of keep the share dilution created by these bonuses under control. So I guess my question is that are we maybe looking at dividend investing as kind of like this sort of 20th century definition? And should we include a share buyback with a dividend? Should we maybe look at a shareholder yield rather than just straight dividend yield? Is that something that we should consider? Or should we just say dividends and share buybacks kind of don't count, or they're a bonus or something?
That's a very good question. I think it ultimately comes down to your goals, right? So if you're thinking of living off dividends and cash flow is key, then you tend to look at stocks that are a little bit higher in yields. But if you're more of a kind of like us, we're hybrid investors, we're investing in index and dividends, we're looking at that total return. We want both cash flow and return. Right? But yeah, I think it will be interesting, and I think a lot of these tech companies, they are increasing their payouts. Not Alphabet, but if you see the likes of Microsoft and Apple, they don't have very high yield, but they're definitely growing their dividend payout at a pretty decent pace. So yeah, I think share buyback is definitely something you should look into, because that's another way for the company to increase its share price, right? By buying share. And Apple is a very good example. They've been doing share buyback for many, many years. Whenever they think their shares are undervalued, they tend to use the money they have to buy back shares, and that essentially drive the share price up. And that's a good way to, as a shareholder, to get your money returned at a good pace.
Yeah, share buybacks too, the advantage to them. And for the record, I'm a dividend investor, but I, for the most part, really like share buybacks. I like them because one is that, like Bob said, it's a way of returning capital, but you're essentially trying to increase the share price by doing it, because the company is worth the same amount, but there's fewer shares outstanding. Therefore, the share price should go up. And the other reason why I like stock buybacks so much is because they generally make a dividend easier to afford, and they make a dividend more likely to be increased in the future. So I'll use some kind of simple numbers here. There's 1 million shares outstanding. You pay $1 a share in dividends. It costs the company $1 million. If there's 900,000 shares outstanding and the company pays $1 in dividends, it costs $900,000. So you have this savings that come from having fewer shares outstanding. You don't have to pay the dividend on those shares. So what the company can do is it can increase the dividend to $1.10 per share, and it'll still only pay out approximately $1 million. Not quite that amount because of the way the math works, but you get that much easier dividend increase when you have a share buyback. And that just only helps the dividend go higher over time, which is what a lot of investors are looking for. They're looking for that dividend growth, and anything that can make that dividend growth easier is a plus. Now, of course, sometimes with share buybacks, you can do one that Canadian National Railway, CNR, is one example where that as a stock that's consistently repurchased shares for 20 or 25 years, sort of methodically over the years. And so, of course, what happened is that in the 2022-2023 period, is shares are a lot higher than what they are now. You're seeing the stock sell off based on, like the tariff talk, Canadian recession talk, and then there's the proposed merger with the Union Pacific and the other railroad that I forget its name, I'm sorry, in the United States right now. So the stock is sold off. And because of that, the share buybacks that the company did at like $200 a share look terrible right now because the stock is at like 130. So that's just, I don't know, like there's share buybacks are tricky sometimes, and for the most part they're positive, but sometimes you can look at them and you can say, hey, that probably wasn't the smartest share buyback to have done.
For sure. And that's where you have to have quite a bit of faith in the management group. If I see management group keep doing share buyback and the shares at all-time high, that simply just doesn't make sense. I think share buyback is a very, very good weapon that companies could weaponize when their shares are undervalued. And of course, only if the company has cash around. Like, doesn't make sense for them to take on debt to simply buy back shares. That's kind of silly in my opinion, but some companies do that.
Yeah, and two, I mean, you're exactly right, where the buyback should happen when shares are depressed. But when shares are high, generally the company has the most amount of cash because they're generating a lot of cash, and the market is happy about that. And that's why the stock is up. Mm-hmm. And so it takes that discipline in order to do it. And there's a lot of management teams that just don't have that. They'll just say, hey, we have the money. Let's use it to repurchase shares. And maybe in that situation, a special dividend is best or something like that. It's that's always a tricky situation where, the managers of a company, you're trusting them to allocate capital at the end of the day. And when they have the most amount of capital is probably not the time that they should be allocated it. They should let that sit on the balance sheet or use it to buy back, sort of pay off debt rather than buy back shares. Mm-hmm. So it's tricky. And, you can look at this from I don't know, I'm trying to bring this back to a indexing versus dividend kind of metaphor here. And I guess just it kind of comes down to when you're selling, the time to sell obviously is when things are high, but maybe that's not the time for things to buy. And then, I don't know. I guess the point is that this stuff is complicated and it's not easy, and that's what makes it fun.
Yeah. So we're coming up to time here, but one interesting question I want both of us to answer is, knowing what you know today, if you were to start investing today, knowing what you know, like you say, you could go back in time and you're just starting out now. Would you stick with dividend investing or would you go with index?
I would stick with dividend investing. And for me, the reason is I think that it's the best style for me in terms of giving me that sort of, I'm going to call it a dopamine hit of consistent income all the time. That encourages me to stay invested. It gives me fresh capital that I can put to work in kind of whatever opportunity that I see. And ultimately, it's the form of investing that excites me the most. And if I'm excited, if I'm motivated to keep investing, that's the important thing. And dividend investing for me, and maybe not for anyone else or even for you listening, but for me, it's the easiest way, the most effective way to keep me in the game, keep me motivated, keep me excited. And that's ultimately going to be the thing that helps me the most. Now, how about you? I mean, I know you started more dividend and then you've kind of like moved to a more hybrid approach over the years. So what would you do if you started over again from scratch?
Yeah, and that's something I thought about it, and then I've been giving coaching clients these similar advices. I if I were to start out today, I would probably stick with an index, so probably either a VQT or XEQT, and build up like a sizable portfolio with one of these ETFs, right? So probably somewhere around like 50,000 or 100,000 before I would touch dividend investing, right? So I would build up the, say, XEQT to 100K. And once I hit that milestone, I would then pick 10 or 15 or 20 dividend stocks and start investing money toward those dividend stocks, such that we're still doing hybrid investing. I think there are a lot of benefits doing both index and dividend. And obviously cash flow is important to us, but again, total return is the most important thing here. Mm-hmm. So I wouldn't change anything what we're doing, and it sounds like you wouldn't change what you're doing today.
No, I really wouldn't. I was just going to add that for the average person, for probably not for the average person listening to this podcast, because generally if you're excited enough to hear us talk for 45 minutes about the total return versus dividend debate, you're obviously into finance. But for the people who, and we both have friends and family who aren't really into finance, who just sort of want to find a very simple solution, the answer for them is 100% indexing. Whether, if they do have an appeal for, like a dividend, they want that cash flow, then there are dividend ETFs that they can pick. But for the most part, for the average person who isn't really into finance, just make it easy. And the easiest way is a ETF like XEQT. Put your money in it every 2 weeks and just forget about it, basically. When you're not really into finance, you're not really into this whole world, the simple solution is best. It'll do so much better than trying to complicate things. I think that's the message that I'd like to,
Yeah, and I think end of the day, the important part is you're investing your money. You're not hiding your money under the mattress, right? And inflation is just eating into the purchasing power. So as long as you're investing your money such that money is growing, whether it's index or dividend or it doesn't really matter. As long as your money is working hard for you, I think that's the key here. We could debate back and forth about index versus dividend, but who cares? As long as you're investing and your money is working hard for you, like keep it simple, keep it stupid, right? And mm-hmm. Consider your goal, right? Don't focus on that extra 1% return just because you heard from somebody that thinks they give you an extra 1%. Focus on your financial goals.
Yeah, that's it. The end of the day, there's no winner in this debate. The winner is whoever uses each of the strategies to become wealthy and to reach their financial goals. The way you get there is not as important as getting there. That's really great. Okay, we're going to end it here, Bob. Always a pleasure to talk. I guess we'll chat again next week.
Yeah. Talk to you soon.
All right.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.